Good morning, students. Welcome back to the session of interest rate risk management. Till the last session, we have studied about some of the techniques to manage the interest rate risk. And question number 6 is what we will start from today. So during the last session, we have studied on the one technique called interest rate collar. This is one of the strategy in which we said that the person or the entity will purchase a cap and will sell a floor so that the premium cost is not there for purchasing a cap. And we also said that this strategy will make sure that the entity is operating within some level of a upper limit and a lower limit. Okay, that we will prove how with the help of this question number 6. This will further strengthen our understanding on the interest rate collar. So question number 6 says that XYZ Inc. issues a euro 10 million floating rate loan. So first of all, students, as we have studied in our earlier session, definitely floating rate loans are those where the interest rate keeps on changing. It is linked to some kind of a base rate, which we had a proper discussion in the last session. In this case, let us go on further read the question. On July 1, 2013. So on 1st July 2013, XYZ Inc. issues a loan, which is a floating rate loan. That means the rate will keep on changing depending on some of the benchmark rate. Okay. It says that with resetting of coupon rate means the interest rate, and resetting means that when we will make the change in the interest rate. Resetting means when we are going to reset the interest rate. After coupon rate every 6 months equal to the LIBOR plus 50 basis points. So students, if you see, it is saying that after every 6 months, so today is, let's say, 1st July 2013. Okay. Let's say this is 6 months. From that, then there will be 12 months. Then there will be 18 months. So likewise, and it will go on for 6 months. So the interest resetting or the interest comparison against the LIBOR will happen on these dates. And it will be applicable for the next 6 months. The interest will be applicable for the next 6 months. And the overall cost of borrowing for this entity is LIBOR plus 50 basis points. Okay. Now, so this is the existing situation. This is the existing risk for XYZ Inc. Why? Because there is a risk of LIBOR going up. Correct? What if the LIBOR goes up, the cost of borrowing for XYZ Inc. will also go up because it has issued a floating rate loan. Correct? Now, what does XYZ feel is XYZ is interested in a collar strategy. Okay, by selling a floor and buying a cap. Okay, that is what we studied in interest. This collar strategy. We sell a floor and buy a cap. Why do we need to buy a cap? So as to get some kind of a guarantee that what is the maximum rate, what is the cap rate of the interest rate guarantee, that will be our maximum cost. And why we are selling the floor? Because while we will buy the cap, we will pay some premium. Now that premium we will realize from the selling the floor. Correct? Now if we see, XYZ buys the 3 years cap and sells 3 years floor. Okay, so 3 years, the same duration is there. As per the following details on July 1, 2013, the notional principal is euro 10 million. The reference rate is 6 months LIBOR. Okay. Strike rate 4% for floor and 7% for cap. So that means the floor rate is 4% and the cap rate is 7%. Premium is 0 because since premium paid for cap is equal to premium received for floor. In a way, we have actually made good the loss on account of the premium which we would have paid in a cap purchase by selling a floor. Correct? Now, using the following data, you are required to determine the effective interest paid out at each reset date and the overall average overall effective rate of interest per annum. And on these different resets date, they have given us the actual LIBOR that has turned out to be. Okay. So first of all, let us tabulate the number of data. Yeah. Okay. So let me just put the reset dates first. 31/12/13. This is 6 months from the first date. This is the first reset date. And the reset dates, we can see it from here also. If you see here as well, there is 6 months gap between all of them, as we have told in the question. Then 30th June 14, then 31/12/14, then 30th June 15, correct? Then 31st, then 30th June 16. This is the last date. 1, 2, 3, 4, 5, 6. Total 6 resets date. And we are also given the respective LIBOR percentages. So it's 6%, 7.5%, then 5%, 4%, 3.75%, and 4.25%. Okay. Further, we were also given what is the cap rate. Cap rate is 7%, and floor rate is actually 4%. Now, let us plot the number of days also, so that we will calculate in number of days. So this is 184 days. If you calculate exactly, then 181, again 184, 181, then 184, and 182 as per the leap year. So total days are how much? 1096, which is equivalent to 3 years, correct? Now, what is the normal interest? See, students, first of all, please do remember that in all the techniques of interest rate risk management, we are doing settlement on net basis only, not on gross basis. It's not that actually under the cap or floor, the principal or notional amount will be given or taken, and hence the adjustment will happen at 7 or 4. No. It is only the net adjustment that is going to happen, even in case of interest rate for this forward rate agreements, interest rate futures, as well as interest rate options, correct? So first of all, the normal interest will be paid on the total amount for the actual rate of interest, correct? So if we calculate for 184 days, what is the normal interest going to be on 10 million euros, correct? On 10 million euros, it is going to be 327,671. And we can just say that we are assuming 365 days in a year. So basis that, if we take LIBOR plus 50 basis point and take a 10 million euro and apply 6% as LIBOR, the normal interest comes out to be this. Then 396,712 for the next 6 months, 277,260, 198,356, 189,041, and 236,849. This is just a normal interest calculation that we have done till now, correct? Number of days, LIBOR reset for 6 months, or number of, instead of taking 6 months, we have taken number of days, and what is the normal interest coming out to be. Now, since we have purchased the cap, correct? There are chances that there will be a cap receipts, correct? Because if the interest rate goes beyond 7%, then there will be a cap receipt, correct? Cap receipts. And since we have sold the floor, we have written the floor, that means we are actually writer of the floor option. That means in case the rate goes below 4%, we have to pay interest. We have to pay some differential, correct? So I'm writing floor payments because we have written the floor, correct? Cap receipts will be there? No, because it is 6%. In the first case, it will not be there. But in the second case, actual rate is 7.5. My cap that I've purchased at 7%. So I will get equivalent to 0.5 percentage for 181 days on 10 million euros, which is the notional amount, as a cap receipt, which comes out to 24,795. So if I take 10 2.5 percentage into 181 divided by 365, it comes as 24,794. Now, Namita is asking, sir, we are adding 50 basis points in every 6 months. So we add total 50, no. So we add total 50 basis points for entire 3 years. No, Namita. See, you're definitely adding 50 basis points in every reset date, but you're only calculating it for 184 days. Okay. You're calculating only for 184 days or 181 days. Hence, the impact is that 50 basis point in this first reset date is only coming for 6 months, which is 0.25, which is 25 basis points, correct? Okay. Namita, I will take your other queries after this. So basis points is, Namita, is actually, if you see basis points, 1% is equal to 100 basis points. Okay. So if we talk about 10 basis points, 10 bips, it means 0.1 percentage. 50 bips means 0.5 percentage. Okay, Namita, this is called as basis point. This is a very standard terminology used across. Okay. Now, coming to the next one, 5%, there is no cap receipt, 4% no cap receipt, 3.75% no cap receipt, 4.25% no cap receipt. Why? Because everything is below 7%. Why will I exercise the cap option? I will just go in the open market and do the borrowing, which I have already done. Now, in case of floor payment, the interest, the differential needs to be paid in case the interest rate goes below 4%. So in the first case, it is not there. Second case, no. 5% no. 4 to 4% also no, because it is still at the money option, correct? Then 3.75 is where the floor payment needs to be done. And this floor payment will be done to the extent of 0.25 percentage, correct? Which is what the difference between 4% and 3.75%. Just a second. Yeah. Okay, so 0.25 for 184 days on 10 million euros comes out to 12,603. 12,603. This is a negative amount because we are paying this. Or else everything is a payment only except for the receipt. We will just adjust in the formula itself. Okay. Then last part also there will be nothing. Correct. So the floor payments and cap receipts are also calculated. Now, what is the effective interest? So this will be as is. So effective interest is the normal interest minus cap receipt plus floor payments. That will be the total interest payment, correct? So the first one is 327,671. Second one is 371,917. 277,260. 198356. Then 201,644. Now in this, the amount gets added, right? 189,041 plus 12,603. And the last part is actually 2,36,849, the same amount. This is the total interest that we have paid, 162,609.4. This is the total interest that we have paid for 1096 days. So can we calculate the effective interest applicable for us per annum? This is 10 million multiplied by 100. multiplied by 1096 divided by 365. This we are doing because this is the total interest, correct? This is the total interest for 1096 days. So this comes as 5.42 percentage. Okay, so the annual effective interest rate is equal to 5.42 percentage. Now students, this is the point that I was trying to say is under a collar strategy. Okay, I will just display the solution once, but please listen to me very carefully because this is the conclusion that we are making now. There is a cap rate of 7% and there is a floor rate of 4%. Always your effective interest will lie some like this. Between 7% and 4% only, your effective interest will obviously lie. Why? Because it can't go up beyond 7%, because the moment it goes beyond 7%, you will recover the money from the option writer. Because you are holding the option, you have purchased the cap. I'm writing here, purchase cap and sell floor. Okay. And the moment interest rate goes below 4%, you will have to make the payment, whatever is the differential amount, to cover up for that 4%, up to 4%. So that means your interest rate can never be below 4%. Correct? It will be always between 7% and 4%, between that range. And what you have done is you have nullified the premium. So premium, there is no cost. And you have maintained a range within which you will end up getting the effective interest. Okay. So this is what the outcome of a interest rate collar strategy is. Now, let me take the queries one by one. Yes. So Sairam is asking, I am not getting the notional interest amount. Okay. So Sairam, I'm just referring this one interest calculation here. Okay. So how we are calculating is, there is a, what is the LIBOR? LIBOR is 6% plus there is a 50 basis point addition in that. So 0.50%. This is our total interest, correct? Because if you read out the question, it says that the cost is equal to LIBOR plus 50 basis points, correct? So that we have noted here. This percentage has to be applied on 10 million euros, correct? For 184 days, correct? The first reset date is having 184 days divided by 365. Okay, this is how we will get 327,671. And likewise for others as well. For others also, this 50 basis points we need to add in the LIBOR. Okay, Sairam, I hope this is clear. Now, Namita is asking what is reset date. So, Namita, reset dates are these dates only, where there is a comparison against the base rate, which is the LIBOR in this case, correct? Against any base rate, on what date we are going to compare it. That is called as reset date. Okay. Namita is asking, sir, in study material, it is written that borrower can make profit by buying future at a closing date. So if he has already having short position futures, then why he would buy it? Okay. So Namita, if this is a simple principle from our derivative session as well, and even this is applicable. So if you are having a short position in futures already, correct? To book the gain, you will have to take a long position, correct? Because until unless you take a long position, your gain will not be booked, correct? Because still short position is one-sided exposure only. We're getting the point. So hence you have to take a long position to book the gain. Hence it is mentioned correct only. Then sir, if next question from Namita is, if bank want to take loan after 3 months for 12 months, it will write FRAs 3/15. Yes, that's right. Namita. Then last question from Namita is, sir, if interest rate becomes 3%, then we need to pay 1%. Yes. So it will cost us extra than our normal borrowing rate. So yes, Namita, that's what the collar strategy is, and that's what I was telling you now here as well. If it goes below 4%, let's say 3%, then you have to pay additional 1%, and 3% you are already paying. So it will make your overall cost as 4%. But but what has happened is that always your interest will remain within 7% and 4%, as we discussed. The only benefit that you're getting is of the premium here, correct? Because if you would have not sold the floor, you would have also not got the premium also. You're getting my point? So definitely, yes, this situation will be disadvantageous situation, but not in the overall scheme of things. If you see, you're receiving the premium as well. Okay. And also, a person will enter into collar strategy once and only once if he's very sure that interest rate is not going to go below 4%. Then only he will go ahead and do the deal. Correct. But if in actually also if it comes down below 4%, then yes, you're right. He has to make loss. He has to make good the loss, which is this 1% he has to pay. Okay. Now let's move on to the next question. Yes. Now pay attention, students. Two companies, ABC Limited and XYZ Limited. Now there are two companies, ABC and XYZ. They approach the same bank called DEF Limited for FRA, which is forward rate agreement. They want to borrow a sum of 100 crores. Both of them wants to borrow a sum of 100 crores after 2 years for a period of 1 year. That means we are talking about a FRA of 2 by 3, correct? In terms of years. This is not in terms of month, in terms of years. Okay. Bank has calculated the yield curve. Yield curve is nothing but the rate of interest curve, correct? The percentage curve of both the companies as follows. Year 1, 2, 3, XYZ is this, ABC is this. If you see, students, ABC Limited yield curve is valued at is basically the cost of borrowing for ABC Limited is higher. Why? Because the difference in yield curve is due to the lower credit rating of ABC Limited. Definitely, if ABC Limited is having a lower credit limit, it will mean that the ABC Limited will end up paying the higher interest compared to XYZ Limited. Okay. Now, first part is you're required to calculate the rate of interest DEF Bank would quote under 2 by 3 FRA using the company's yield information as quoted above. So first of all, it is asking us to do the valuation of FRA, which is very easy, correct? Let us quickly do that. So first part for XYZ Limited, the valuation of FRA that will be quoted. Now, students, if you see, there is 0 and 2. This is the second year. After second year till third year, this is 1 year. It will go, correct? The FRA is 2 by 3, correct? So we have to take is like this, correct? We have to take the interest rate for 3 years, and we have to take the interest rate of 2 years, and hence we will be able to calculate the FRA rate of 2 to third year, second to third year by using that simple equation that we have studied, correct? So what was that equation? 1 plus for 3 year it is 4.48 percentage, 1 plus 4.48 percentage, but this will be taken as raised to the power 3 because there are 3 years, so we will compound it for 3 years. Then 1 plus what is the 2 years rate? 2 years rate is 4.2 percentage. So 4.2 percentage that will be taken for 2 years because the compounding will happen for 2 years, and this whole multiplied by 1 plus r percentage raised to the power 1. Because this r percentage, I am assuming r percentage here, which is applicable for 1. So this 2 year rate multiplied by 1 year rate will give us 3 year rate, should be equal to 3 year rate. This will give us arbitrage free FRA price, or we can say that this is the theoretical minimum valuation for a FRA. Okay. Now, if we solve this, so R comes as 5.04 percentage. Okay, students. So this comes as 5.04 percentage. So for XYZ, it will be quoted as 5.04 percentage, 2 by 3 FRA. Okay. Now coming to ABC Limited. So students, if you see in this question, the first year as of now is no use. This 3.86 and 4.12 is of no use because we are talking about 2 by 3. So 2 by 3 will make use of second year and third year, correct? So similarly, now substituting for ABC Limited in the same equation, we will get 5.78 percentage cube, which is for the 3 years, 1 plus 5.48 percentage square, 1 plus R percentage. Okay. So if we calculate this, R comes as 6.38 percentage. This is again for 2 by 3. Now, students, if you note, for ABC Limited, the FRA is expensive. Why? Because ABC is having a lower credit rating compared to XYZ. Because for XYZ, the FRA is 5.04, ABC, the FRA is 6.38. Okay. Now, the next part is, suppose the bank offers interest rate guarantee. Now, don't get confused here. We are already studied that interest rate options are also called as interest rate guarantees. So here the bank is offering, the bank is writing the interest rate option. The bank is giving the interest rate guarantee for a premium of 0.1 percentage of the amount of loan. The premium is 0.1 percentage of the amount of loan. You are required to calculate the interest payable by XYZ Limited if interest rate in 2 years turns out to be 4.5 or 5.5. They have given us two situations. So they are saying actually the rate of interest is 4.5 and 5.5, and there is a premium required to be paid as 0.1 percentage. Now you tell us what is the overall profit or loss here. What is the overall interest cost? Sorry. Okay. So as of now, we will only talk about the XYZ Limited, correct? Now, students, please note the FRA percentage, the theoretical minimum price is coming as 5.04 percentage. And in the question, in the second part, we are not given what would be the strike rate, what would be the cap rate, correct, of the interest rate guarantee. Now, since if you go through the flow of question, in that only, first of all, the bank has calculated the FRA rate. Definitely, bank will offer the interest rate guarantee on the same FRA rate. Hence, we will have to take the cap rate is equal to the FRA rate. So the cap rate that we have calculated for XYZ Limited is 5.04 percentage, correct? So this is the cap rate, and the premium is going to be 0.1 percentage. Notional amount, what was the amount that they are going to borrow, is 100 crores, correct? Now, there are two cases that we are given, 4.5 percentage and 5.5 percentage. Now, what is the interest cost? First of all, let us start with a very simple calculation, the actual interest cost. Actual interest cost here will be 4.5 percentage on 100 crores multiplied by 1 year, because the period of borrowing actually is 1 year. Although it is going to borrow after second year, but the period of borrowing is 1 year. So this comes as 4.5 crore. Now for 5.5 percentage. Now see students, if the interest rate has gone beyond 5.5 beyond 5.04 percentage, the effective interest that would be applicable to XYZ will be only 5.04 percentage only, correct? Because whatever is the extra difference, it will recover from the bank. Hence, I'm taking 5.04 percentage directly here, correct? 100 crore into 1 year. So this comes as 5.04 crores. But there is a premium also that needs to be paid, which is 0.10 percentage. So which is 0.10 crores. And here also it is 0.10 crores. Why premium? Because premium has to be paid in either of the cases, correct? We don't know now what is the situation going to be, correct? But the premium has to be paid at the time of booking the interest rate guarantee. So the here it comes as 4.6 crores. Here it comes as 5.14 crore. Now here, if you see students, still it is cheaper than what we would have ended up paying if we have not taken the interest rate guarantee, correct? In that case, we would have ended up paying 5.5 crore, correct? 5.5 crore if no guarantee. So still this is cheaper. So this is what the question had asked us to calculate. Simple. Now Namita is asking, sir, if we take long position, then what will happen at maturity? So, so Namita, if you ask me from the derivatives point of view, this long position, if you're taking a long position and you are not squaring it up by taking a short position anytime, then on maturity, automatically your reverse position will be taken up, and whatever is the gain loss from the long position and the maturity will be calculated, will be deducted or paid to you. Okay, Namita? But since we are discussing on the interest rate risk management and the derivatives also, we studied how to do a proper hedging, which is the risk management again. In that case, we will take long position because we are already having some other position in the spot market, correct? So those movements will offset one another. So spot market is moving like this, the derivatives market will move in the other direction, and hence it will, because we have taken the long position or the short position vice versa compared to the spot market, hence it will help us. Okay. Sir, in question number 6, suppose SBI need to pay FD at the rate 6%. If interest rate falls to 3%, then SBI need to pay 6 minus 1%, which will increase to get this question. Just a second. Let me read out it again. If in question number 6, suppose SBI is where? You're talking as XYZ, Navita, I'm not able to understand. This question number 6 is from where? Need to pay FD. So Navita, the facts are not very clear. I don't know which question are you referring to, because there is no SBI, there is no FD at the rate of 6%. We will continue. Namita, please elaborate or please specify the question again. Okay. Because I don't know whether you are asking about interest rate collar or interest rate guarantee or what exactly. Okay. Yeah. Now let us come to the very, very, very important part called swaps. So all the students, please pay 100% of your attention now, because if we miss this, then we will not be able to understand the further things, because I'm just building some concepts again, and then we will attempt some of the questions. Okay. So I'm just giving one situation. First of all, we will discuss one situation and then we will try to understand what has happened in that entire situation. Okay. Now, students, please, again, I'm saying, please listen very carefully, and then only you will be able to understand the entire connect, because if you lose in between somewhere, you will not be able to understand the whole thing. Okay. So there is a company A. Okay. There is a company called company A. It is a very well established company. Okay. It is very well established company, and it has been there in the industry for very long. It has a very good profitable business. It is very good company. I mean, it is very well established company. Okay. Now, but it needs loan because it is doing some kind of an expansion. It is doing some kind of a project. It needs some loan amount. It needs to borrow some amount. So it approaches to its bankers called Bank A, for example. The company A generally deals with Bank A, and it approaches Bank A and says that, okay, I need some 5 crore rupees, for example. Okay, I need some 5 crore rupees. So you quote me that how much interest you will charge from me. So bank says that, okay, we have two quotations for you. One is the fixed loan or the fixed coupon rate, correct? Or I can say fixed coupon. Fixed coupon is 7%, and variable variable coupon means it is floating, correct? Instead of variable, let me write as floating. That is more convenient to understand, correct? So floating coupon is, let's say, LIBOR. Now LIBOR is not there, as sir have told in the previous session, but still I'm taking LIBOR, or you can assume it to be any other thing, correct? Any other base rate, you can assume it to be MIBOR. But that is not the focus area. The focus area is bank A has given two quotations to company A. It says that if you want to enter into a fixed coupon rate, I will fix it at 7% for you. This is what bank A is saying to company A. Further, bank A is also saying, I'm giving you another option. If you want to go for a floating coupon rate, I will give you equivalent to the LIBOR. I will not charge any basis point extra on LIBOR because you are already well established. There is no risk of non-payment. There is very less risk of non-payment. And I know that my loan will be very much secured with you because you have already have a very big name in the industry. Okay. So now comes separately, there is a company called company B. This is separate, correct, from company A, no link to company A. Now this company B is a very new company. It's just like a startup. They are burning cash, correct? They are increasing the valuation, but the profitability is all negative, correct? So what they and for doing their activities also they need cash, correct? So they approach their bankers called bank B. Now if they are approaching their own bankers called bank B says that there is a very high risk of non-payment. There is a very high risk that you will not be profitable in future since you are not profitable now. So I can give you the loan amount that you need because that is what my business is, the bank is saying, but I will charge a fixed coupon of 10%, okay, and a floating coupon of LIBOR plus 1%. Now see students how the bank changes their interest rates depending the company. Now bank B is actually, in case of fixed, is keeping 3% higher, and in floating it is keeping 1% higher than LIBOR, correct, to cover up for the higher risk of non-payments. Okay. Now both of them, now company A and company B, both of them are evaluating that whether we should take as a fixed rate or whether we should take as a floating coupon rate. Okay. Now there is now fifth entity in this entire situation. There is a fifth entity. What happens? Both company A and company B, while taking this decision, both of them approach a fifth entity called swap bank because they are not able to decide whether it is good for them to go for a fixed coupon rate or it is good for them to go for a floating coupon rate. Okay. Both of them are not able to decide. So both of them approach this bank called swap bank. Now they tell their entire thing to the swap bank and says that, okay, what is the situation with both of you? Now, swap bank does a very simple calculation. Swap bank says that what if both of them, there are only two possible options in this. This is what swap bank is doing, because already company A and company B have already told them what is their respective banks are quoting. Now swap bank have that information. Now it sees that, okay, what is option number one? Option number one is, I ask fixed from A and floating from B, which is 7%. This one, fixed from A and floating from B, and LIBOR plus 1%. Correct? This is floating from B, this is fixed from A. So this is what is the cost totally of the entire borrowing of A and B put together is L plus 8%. Correct? What is option 2? Option 2 is fixed for B plus floating for A. Correct? So fixed for B is how much? 10%. Floating for A is how much? LIBOR plus 0. There is nothing, because only LIBOR is the floating rate. So here it comes as L plus 10%. Now, swap bank have that information, because see, both company A and company B don't know each other. They have only approached an intermediary called swap bank, and that bank now have done this calculation, and it comes to know that option 1 will be cheaper compared to option number 2. This is cheaper. Why? Because in this, they will end up paying in totality as L plus 10%. In this, they will end up paying as L plus 8%. Okay. So now swap bank says that, okay, here it goes. It instructs. So swap bank instructs company A to borrow in fixed. Actually, company B to borrow in floating. Actually. Okay, this is what swap bank have said. Now, since company A and company B are also two independent companies, they will also have their own finance team. Okay, they will also have a lot of chartered accountants working in there. Now, what those chartered accountants say is that, for example, company A finance team is saying, why would we go for a fixed? We are a well-established company, correct? We have good reputation. Why should not we go for a LIBOR? Because tomorrow, if the LIBOR is lesser, we should get that benefit. And tomorrow, if LIBOR is higher, we can take that risk. Correct? We can take that risk. Why? Because we are already having a good profitability, but there is a chance that LIBOR might come down, and hence our overall cost will also come down. Correct? So company A says that I will prefer floating here. Similarly, company B's finance team says that we have just started. Why should we lock ourselves in something that we don't know? The future is uncertain. Already we have uncertainty sitting in our financials. Why should we enter into LIBOR plus 1%? We will go with what is certain, and certainty is the fixed coupon of 10% currently. Because we have just now started, correct? So we will prefer fixed. We don't want to take any risk anymore going forward. We will prefer fixed, and company A says that we will prefer floating, because tomorrow if the rate comes down, we would want to get that benefit. And if there is a possibility that rate is going up, we are okay to absorb that extra cost, because we are already very profitable. Hence, we want to take that risk. Company B saying we don't want to take a risk. Let us make it fixed, and we will go ahead with the 10% only. Now, both. Now, Swap Bank have told company A to borrow in fixed and to company B to borrow in floating. Then company A has switched back to Swap Bank saying that no, this is not our preference. Our preference is totally different. It's totally vice versa. Now see what in Swap Bank also now there is another finance team sitting in Swap Bank. Okay, they say, okay, what if I do one arrangement in which I will make sure that both of your preferences are also meeting, and what I am also suggesting is also meeting. Okay, now this finance team of Swap Bank will say that, okay, I will make sure that the preferences of company A and company B is also meeting, and the Swap Bank's calculation of option 1 is also meeting. Okay, now see what Swap Bank asks both of them to do. First of all, Swap Bank says that, okay, you go ahead with what I'm saying. It says to company A, you go and borrow 5 crore rupees, because 5 crore is required to both of them. I'm taking this an example. Okay, 5 crore you borrow from bank A. Okay, and you pay them an interest of 7%. I want you to borrow. So Swap Bank says to company A, I want you to borrow in fixed. Okay, you borrow in fixed at the rate of 7% and take 5 crores and you use that money and you keep on paying 7% to the bank A. Swap Bank says to company B, okay, you take the interest. You also take the loan of 5 crores because that 5 crores is the notional amount that you need, correct? Again, I'm assuming the amounts are same only in both the cases, then only the swap will work. You also take the 5 crore from your bank, but you take it on L plus 1%, LIBOR plus 1%. Okay. Now, what Swap Bank will say, okay, it will ask company A to pay LIBOR to Swap Bank, LIBOR percentage, whatever is that LIBOR percentage, correct? LIBOR amount, LIBOR equivalent percentage amount to Swap Bank, and Swap Bank in turn will pay that LIBOR percentage to company B. Okay, the same LIBOR percentage to company B. I'm putting percentage here, correct? So company B is sorted because company B has paid LIBOR and it is also receiving LIBOR. Correct. So company B is sorted. Company B is saying, okay, now there is no variability at all. Because if tomorrow the LIBOR goes up, I will pay higher and I will receive also higher. Correct. Company B is sorted. But now the effective cost of company B is only 1%. Correct. So what Swap Bank will say to the company B, okay, you pay me 8.25%. Okay. And Swap Bank will pay to company A 7.25%. Sorry, 7.75%. I will tell you, just don't go into the figures as of now. We will first prove the calculations and then we'll see. 7.75% will pay. Now, what Swap Bank is doing? Swap Bank is not doing a charity. They are also there to earn. So it will receive 8.25% from company B and only pay 7.75 to company A. So 0.5% is what they will keep as their own commission. Because Swap Bank will say, out of this entire arrangement, I will give company A also some kind of benefit, company B also some kind of benefit, and to myself also I have to earn some commission. That is what Swap Bank will say. Okay. Now, for company A is paying fixed at the rate of 7%. It will keep on receiving 7.75 as fixed, and it will keep on paying the LIBOR. Company A preference is also met because company A preferred to pay floating. Correct? Now, if I say after swap, company A, see, first of all, it is paying LIBOR to Swap Bank. It is paying 7% to Bank A, and it is receiving 7.75% from Swap Bank. This is company A. After swap, this is the net numbers. So this is L minus 0.75 percentage. Company B. Company B is paying L plus 1 to bank B, L plus 1 to bank B, and it is receiving LIBOR from swap bank, and it is paying 8.25 percentage to the bank. This is all in percentage. I am just skipping the percentage being mentioned here. Okay. So this is all in percentage that we are doing. So here the L will cancel from L because whatever L is paying is receiving L as well. So the effective cost comes out to be 9.25 percentage. Swap bank gets a commission of 0.50 percentage. If you total all of them, students, if you total all of them, this will be how much? L plus 10.5. So this will be L plus 10.5 percentage. Sorry. Minus 0.25, right? This will be lesser only. Just a second. 9.25 minus 0.75 plus 0.5. So L plus 9 percentage. Is this right? Yes, L plus 9 percentage. This is what the overall cost has come out to be. Now, students, if you see, what if company A would have gone and borrowed as per their own preference? They would have ended up paying L. I'm just writing with some other color here. Directly, if they would have borrowed L. And here, if they would have borrowed directly at fixed, they would have borrowed at 10 percentage. Correct? They would have borrowed at 10 percentage. But now the actual borrowing that swap bank have told them is 9.25 percentage, and the actual borrowing here is L minus 0.75 percentage. So that means both ways there is a 0.75 percentage reduction, and this entire arrangement is called as swap. But swap bank must also ensure that both company A and company B must be capable of repaying the loan as well as the interest payments as and when it becomes due, either to the respective banks or to the swap banks. Correct? Because they have to pay an interest obligation of 8.25 and LIBOR respectively to the swap banks also. I hope, and why this is called as swap? Because now the swap bank have swapped the loan obligations and they have converted the fixed into floating and the floating into fixed for the respective companies. I hope this is very much clear to all of you. The questions are very easy, not that difficult, of the swap technique. It's just that the concept building has happened in such a manner that you understand what is the requirement, what is the need, and what types of actual swaps takes place, and who all benefits in the entire swap. In a way, now all the three of them are benefiting only: company A, company B, and swap bank, all of them. Okay, students. So let me move forward now. Let us go to the next question. Okay, now before the next question, Sairam is asking how should accounting to be done. Sairam, for that, let us keep the accounting part to paper number 1, because that would be the expert guidance under paper number 1 that we can get to account for the swaps. Okay. As of now, I am not commenting anything on the accounting because this would not be the right thing to do in this session. Okay. Namita is asking, sir, if in question number 6, okay, now she has posted the question number 6. Suppose XYZ need to pay FD at the rate 6%. If interest rate falls to 3%, then SBI need to pay 7%, which will Namita, I'm not able to again understand your question. See, what I'm saying is in the interest rate collars. Okay, Namita, please pay attention because that will clarify all the doubts. If you see this concept, okay, which I told here. See, I think your question is around this, how the cost is getting limited, correct? See, the cost is getting limited because if you are purchasing a cap, again, I'm repeating, if you're purchasing a cap and selling a floor, correct? Purchasing a cap means you are locking your effective interest to 7%, not beyond that. If it goes beyond that, the option writer will make good the loss for you. And since you have sold the floor, the moment your interest rate goes below 4%, in that case, whatever is the differential that you will have to pay, that means that will come as a loss to you. That means your interest rate cannot go below 4% because if whatever is below 4%, you will have to pay the differential and make it up to 4%. Okay, so I don't know what you're saying, what you're referring to FD. You're saying need to pay FD at the rate 6%. I'm not too sure what is this FD. Because 6%, 3%, 7% don't have any correlation. I'm moving forward, Namita, but just stick to what we are just discussing, correct? If the interest rate goes below 4%, the cost will be still 4% because you have sold the floor and you have to pay the balance amount. Okay. Yes, it will increase the effective interest rate, Namita, as I told you, but the effective interest rate will always be between 7 and 4%. Correct. Now, why? Now, your question is why will bank enter into such kind of a interest rate collar? Why? Because see, they know that okay, what is the limit within which they want to operate? They have already calculated that limit, and they are okay to calculate. They are okay to operate between 7 and 4. Hence, they will operate into this strategy without incurring any additional cost of premium. Okay. Now, Sairam is asking, sir, if LIBOR is increased, then what will be the treatment to be done? Okay, good question, Sairam. So, Sairam, if the LIBOR is increased, simply company A will end up paying higher interest. That's all. Because if you see at the end, the company A is the only company which have a floating coupon effective rate, right? So if the LIBOR increases, company A's cost will increase. Simple, because it will pay basis the higher LIBOR. That we will cover in the question also. Namita is saying, sir, if L becomes 5%, then L plus 9% is equal to 14%. So it will increase the cost above 10%. L plus 9 percentage, yes, it will increase the cost above 10%. That's right. But see, this L plus 9 is the overall cost, Namita. This is the overall cost. Okay, not from company's B point of view. Company B will still be paying 9.25 only. Whatever that L goes up or down, company B will pay 9.25% only against the 10% that it would have gone directly. Correct? So that 10% that you're comparing, Namita, is not right. Okay, if it goes above 10, it goes above 10. That extra cost will be going to company A if LIBOR goes up. Okay. So Namita, this 7.75 and 8.25 is what the derivation. Don't go into the derivation. I've just kept a number so that the gain is distributed equally in between both of them. So company A and company B, both of them are having 0.75%, 0.75% gain. Actually, I'm sorry. I was wondering why it is coming as L plus 9. It should be L plus 8. Sorry, students. Please make this correction. This swap bank we are paying, correct? It will take the income from here. So it is L plus 8% only. So 9.25 minus 0.75 minus 0.5. Yeah. L plus 8 would be the total cost. See, students, I'll tell you now. Students, please note this correction. I have mistakenly written here as L plus 9%. Even I was wondering why it is L plus 9. It should be L plus 8, correct? Because swap bank is taking this commission. So it should be reduced. Now, see, there were two options initially with the swap bank, L plus 8 and L plus 10%. Now, how swap bank has understood is, okay, in both the options, there is a 2% gain. Now, this 2% gain, how it is distributed is 0.5% has gone to the swap bank as commission. 0.75% has gone to both the parties, company A and company B, which is depicted here. L minus 0.75% against L, if we compare, it is 0.75% gain, and 10 minus 9.25, again 0.75% gain is sitting for both of them. Okay, Namita, I hope I answered your query. I put this 8.25 to make sure that the gain is distributing equally between company A and company B. But practically, there can be some other percentages also. Swap bank can say, okay, company B will only take 0.6% gain, not 0.75% gain. And company A will take 0.85%, 0.90%, the higher gain, because company A is well established. So that can happen. But I have split it equally, hence this is the calculation. Okay. Yes, Sairam. So bank will ask that which option to be taken before the company takes a loan. This is what we have told now, that bank only will direct company A and company B which type of loan you have to take. Okay. I hope the issues are clear. And please note this correction, students. It is L plus 8% only. Okay. Yes. Now let us move forward. Now, students, we were discussing. Now there is a separate concept. Okay. We have studied that there is a concept called LIBOR or MIBOR. I am saying now you can easily understand LIBOR is not there. So replacing I'm still using LIBOR or MIBOR interchangeably. And there is a concept called OIS, overnight index. Overnight index swap, OIS. Okay, now students, see what does these two terminology means. We have already studied that LIBOR or MIBOR is some kind of a interbank rate, interbank market rate. Correct. Even OIS also, overnight index swap, is also a interbank market rate only. Okay. Don't get confused with this fancy name called overnight index swap. It is nothing. It is very easy. Okay. It is also an interbank market rate. So that means it is derived from the transactions that are happening in the interbank market, OIS, overnight index swap. Okay. But this LIBOR or MIBOR is actually for, let's say, 1 month, 2 month, 3 month, 6 month, 1 year. Correct. For the different maturities, there will be different LIBORs that we have studied in the questions as well. For example, 6-month LIBOR or MIBOR would be, let's say, 8%. But 12-month MIBOR will be, let's say, 9%. Both of them are per annum only. Okay. Why 12-month LIBOR is higher? Because the duration is higher. Correct. The bank is okay to charge or pay extra amount because of the duration. So, and one more point, whether 12 months is more risky or 6 months is more risky. Definitely 12 months is more risky. Why? Because you are having a 12 months exposure of the interest payments and the principal repayment. Here you are only having 6 months of exposure for the interest payment and principal repayment. The interest charge here will be less. The interest charge here will be high because this is high risky. This is low risk compared to each other. Okay. So 8% per annum and 9% per annum, because of the low risk and high risk, it is there. Now, if that is the case, this overnight index swap is actually the interest rate for only 1 day. It is not for 1 month, 2 months, 3 months. It is only for 1 day, overnight. What does the overnight means? Between today and tomorrow, there is a overnight, correct? So only 1 day. Only 1 day, what is the interest rate going to be? Definitely, this 1 day will be the least percentage. Why? Because it is the least riskiest period, least risk period, because the company cannot go bankrupt overnight, correct? Or the expectation here is that if we are giving the borrowing, if we are giving the loan to someone only for 1 day, you will charge a very less rate of interest, because you know that overnight that other person is not going to bankrupt. So what I can say is that it would be, let's say, 4% per annum, where 8% per annum and 9% per annum are for 6 months and 12 months kind of a maturity. Because of the higher risk compared to 1 day, it will be only 4% per annum. And this represents the riskless interest rate. Because frankly speaking, in this 4% overnight, there is no risk at all. Okay, I hope this term is clear to you, OIS, and what is the use of this overnight index swap. Okay, now Sairam is asking, okay, Sairam, your query was done. Naveen is asking, I have a doubt in question 5. Yes, Naveen, please go ahead and ask. I have the study material with me. Okay, you can ask whatever is the query. Yes, so let us go to question number 8 now. Okay, now, very good question and very easy question. Question number 8 says, suppose a dealer quotes all-in cost for a generic swap at 8%. See, generic swap is what we have just studied now. That is a very general swap, fixed for floating, floating for fixed. Okay. So it says that suppose a dealer quotes all-in cost for a generic swap at 8% against the 6 months LIBOR flat. See, what is the swap here? Swap is, first of all, we have to see what is the swap. Okay. Fixed 8% for floating 6 months LIBOR. So the 6 months LIBOR will be exchanged for 8%. Simple. Notional amount is 5 lakh. Correct. And it says that calculate the semi-annual fixed payment. It is asking us to calculate the semi-annual fixed payment. So first of all, fixed will be fixed only, right? 8% that we can calculate easily. See, they are saying that calculated basis the 181 days. Okay, so we will calculate first semi-annual fixed payment, 5 lakh rupees, 181 divided by 360 days. 360 days is what it is given in the question, into 8%. Correct? This is the semi-annual fixed payment. This is actually 20,111. Okay, students. So this is semi-annual fixed payment. Now in the second part, find the first floating rate payment for one above if the 6 months period from the effective date of swap to the settlement date comprises of 181 days, which is okay, which is what we have also taken. And the corresponding LIBOR was 6% on the effective date of swap. So they are saying instead of 8%, you calculate basis the 6%. Simple. So floating rate payment. Floating rate payment is again 6% on 5 lakh rupees for 181 days, which comes out to 15,083. This is the floating rate payment. Correct? Then third part, it is asking us if in second above, if the settlement is on the net basis, how much the fixed rate payer would pay to the floating rate payer. Now they are saying that suppose first is the fixed rate payment, second is the floating rate payment, and both of them are settling on net basis. So how much extra fixed rate payer has to pay to the floating rate payer? Okay, Naveen, sure. We will cover that today. Okay. You can ask the query while that question is being covered. So the net payment is nothing but the differential of both of them. See, in this case, why fixed rate pair has to the floating rate pair? Because fixed rate pair would have a higher cost compared to the floating rate pair. Correct. So the net payment is 20,111 minus 15,083. As such, if you see, this has nothing to do with the swap. Correct. There is no calculation on swap at all. We have just calculated what question I've asked us to calculate. Very easy, very simple question. Okay. Nothing involved on swap. It just we have calculated fixed, floating, and then net. And all these three questions have asked us to calculate. 5028. This is the net payment. I hope this is clear. Let's come to question number 9. This is where it will test the overnight index concept for you. Okay, so question number 9 says derivative bank. There is a bank called Derivative Bank. It has entered into a plain vanilla swap. Again, plain vanilla swap is the same swap that plain vanilla swap means with no added complexities. It is plain vanilla, no butterscotch, no other thing on nuts. It's plain vanilla. Okay, it's very plain, very generic with no added complexities. Okay, Derivative Bank entered into a plain vanilla swap through an OIS, overnight index swap. Okay, this is nothing but the daily rate. Daily rate they have entered into a plain vanilla swap on a principal of 10 crores and agreed to receive MIBOR over floating rate for fixed payment on the principal. So, see what Derivative Bank has done. Derivative Bank will pay what? Fixed rate payment to, let's say, any other person with whom it is entering into the swap. And this person will pay to the Derivative Bank MIBOR overnight floating rate. Simple. This is the swap. Derivative bank will pay fixed payment and it will receive MIBOR overnight floating rate. Now, this MIBOR overnight floating rate is the daily rate, the daily borrowing rate. Okay, it means if we borrow only for overnight, only for one day, what is the rate of interest per annum applicable? Okay, now, and this swap is called as overnight index swap because he has swapped the overnight index with a fixed payment. Okay, this is called as overnight index swap. I told you here, actually, if you see this OIS, which is the overnight index swap, it is swapping the overnight rate with the fixed rate. So I'm saying swapping the overnight rate with the fixed rate. Simple. Okay. This is what we have done in this question. We have swapped the overnight rate with the fixed rate. Simple. The swap was entered onto the Monday, 2nd of August and was to be commenced on 3rd of August. First of all, the commencement date is 3rd of August. Correct? That means on Monday, nothing will happen. On Tuesday only, everything will happen. And run for a period of 7 days. They have entered into a swap for a period of 7 days. Respective MIBOR rates for Tuesday to Monday are, these are the respective MIBOR rates, overnight rates. So hence this will keep on changing. If the derivative bank received 317 on net settlement, calculate the fixed rate and interest under both the legs. Sunday is a holiday, work in rounded rupees and avoid decimal workings. Namita is asking, sir, in OIS rate is derived from average of all transactions. Yes, Namita. Now see, you guys are only telling me what is the concept. That's right. OIS is actually the average rate of all the interbank transactions happening for the loans that have a maturity of overnight, that is 1 day. Okay, Namita, you're right. It is the average of all transactions, but only for one overnight maturity period. Okay. Yeah. Now, first of all, see, the question is asking, has given us, okay, what we do is we calculate the floating, we calculate the fixed, which is equal to the net. Correct? This is what the swap calculation means. In the previous question also we did it. In this question, we are given the floating rate. We are given the net payment of 317. We just have to calculate the fixed rate. This is what is required to be calculated. Simple. So let us first calculate the floating rate. Okay. And one more thing, in OIS, there is a daily compounding. This needs to be remembered. There is a daily compounding in OIS because we say that borrowing is for 1 day. If borrowing is for 1 day, that means on the second day, the principal and interest has to be repaid. And this portion involves 7 days. So on 1 day, the second day, you have to repay the interest and principal. Then again, you will borrow the amount equivalent to the interest and principal for the third day. Correct. That means you have to compound the interest because you are borrowing interest on interest also. You will pay interest on interest as well. That's why there is a compounding. Okay. So there is a daily compounding. Don't forget this. Days, principal, MIBOR percentage, and interest. See, students, first of all, Monday, nothing will happen because we have entered the deal on Monday, but it will be executed on Tuesday. Tuesday, the principal amount is how much? 10 crores, right? 10 crores, yeah. 7.75% per annum is the first day interest, correct? Overnight MIBOR is 7.75. So this gives us the interest of 21,233. So how we have calculated is on 10 crores, 7.75% for 1 day. 21,233. 1 day we have taken 1 by 365. Simple. Okay. Now Wednesday. Now students, Wednesday your principal amount will change. Your principal amount will be principal plus interest of Tuesday, correct? Because the daily you are taking the loan and repaying, daily taking the loan and repaying. And hence in the next day, you have to take the loan of principal plus interest of the first day, correct? As I told, 21,233, 8.15% per annum is the rate. Here it will come as 22,334. This is Wednesday. Then Thursday, is 10,00,43567, which will come as 8.12% per annum again. So for 1 day, this will be 22,256. Then Friday, 10,00,65823 7.95 percentage per annum, 21,795. This is again for one day. And here comes the catch. Saturday and Sunday, both of them will be written together. Why? Because question says that Sunday is a holiday. Correct? If Sunday is a holiday, that means on Sunday there is no overnight that is going to happen. So whatever we taken on Saturday, that will roll over on Sunday, and then overnight will happen on Monday. Okay. $618. So 7.98 percentage per annum. Here, the interest rate is calculated for 2 days. Here you remember, students, it is 2 by 365, not 1 by 65. Okay. Here it is for 2 days. Then on Monday, the principal amount is 10, 01, 31, 382, 8.15 percentage per annum. Here it will be 22, 358, 153, 740. So this is the total floating interest. Okay. This is a total floating interest. Now, what we have to calculate is it has received 317. Now, students, if you see, he agreed to receive floating, pay fixed, and net he received plus 317. Correct? Correct? So can we say that floating is how much? 153,740 minus fixed is equal to 317. Simple. Now fixed is equal to 153,740 minus 317, which is equal to 153,423. This is what in terms of fixed he will get. And to calculate the percentage, we will just simply do one thing. Fixed divided by the notional amount. Notional amount is how much? 10 crores. For 7 days will be how much? Sorry, I've written it. Because this is interest for 7 days, we have to calculate for 365 days. Hence, this is the fixed percentage of 8%. Now, Harshad, very good question. He's saying why Saturday, Sunday taken together and not Sunday, Monday. Okay. See, as I told that if Sunday is a holiday, then you have entered the OIS, or let's say the MIBOR overnight rate on Saturday, because Saturday you have that rate. Now Sunday you cannot take another overnight rate equivalent to this amount. Why? Because Sunday there is a holiday. Sunday you can't get an overnight rate. So the same overnight rate will roll over even to Sunday as well. The Saturday rate will roll over to Sunday as well. That means the Saturday rate will be applicable for 2 days. Correct. If we take Sunday and Monday, that means that there has to be a transaction on Sunday. If you want to take Sunday and Monday put together, that means there has to be a transaction on Sunday and there has to be a rate on Sunday, which is not the case. Correct. Hence, we have taken Saturday and Sunday together. Naveen, you have still some query. Please do let me know if I'm not able to clear out the doubt in question number 9. Okay. Please do ask any other questions, students, if you have. This is more or less the swap is correct. Swap is fixed for floating or floating for fixed. Simple. In this case, it is we are receiving the floating and we are paying the fixed. So next question, I think, will take some time to resolve. So what I suggest is let us break for 10 minutes now, because next question will take at a stretch some more time. Let us break now and let us reconnect on 8:35. Okay. I suggest is let us break for 10. So welcome back, students. Just a second. Yeah. So let me take some queries on this. Some good queries have come. Uh, Harshad is saying, then okay, it means that a transaction is happening in morning but named as overnight. That's right. It is happening during the day, Harshad, not in the morning. It can happen, let's say, during the day at any time. But it will happen for only one day. The period, see, overnight comes for the period. Like we have 6 months LIBOR, 8 months LIBOR, 3 months LIBOR. Similarly, overnight means that that percentage is only applicable for one day. Correct? Because generally, practically, if I tell you, Harshad, what happens? The banks also charges, let's say, on OD, right? On overdraft. They will charge interest only on the end balance, right? They will not say that, okay, during the day, what can happen? Let's say 10 a.m. in the morning, I can withdraw through OD. And by 3 o'clock, if I deposit the funds in the OD account, bank will not charge because bank will see the closing amount, overnight amount on whatever is the closing cutoff that they have. Correct. So the transaction can happen during the day anytime, but the interest will charge only for one day, which is overnight. Correct. Sairam is asking, sir, there is any interest on interest will be charged? Yes, there is an interest on interest. That is why we have done compounding. So, okay, let me elaborate it further. Because Namita is also asking the same question. She is asking, sir, if the OIS rate is not available for Sunday, then why we add interest amount of Sunday also? Why we not carry forward balance of Saturday as it is to Monday? No. I'll tell you. See, let's say Tuesday is the first day, correct? Then Wednesday, then Thursday, then Friday, Saturday, Sunday, and then Monday. These are 7 days. Okay, now what will happen is, let's say Tuesday during the day we entered into a deal, correct? For taking a overnight loan of, let's say, 1 lakh rupees. Okay, all of you please pay attention because this is a query from all of you. So on Tuesday we entered into a overnight borrowing. Overnight borrowing, you all understand? Borrowing only for one day for 1 lakh rupees. Okay, and we got that, okay, the rate of interest is 7.75% per annum. Okay, so you pay one day interest. I'm assuming for the simplicity, it comes as 100 rupees. Okay, don't go into the calculation. 1 lakh 100 rupees is the amount that you will repay on Wednesday. During Wednesday, you will repay 1 lakh 100 rupees. Okay, 1 lakh 100 rupees. Now, this 1 lakh 100 rupees is you will repay, and then you will enter into another borrowing overnight of 1 lakh 100 rupees. Correct? Because now you need the funds on Wednesday. How much? 1 lakh 100 rupees, not 1 lakh. You need 1 lakh 100 rupees because using that you will repay the Tuesday borrowings. Then Wednesday you will have to borrow 1 lakh 100 rupees. Similarly, Thursday you will have to borrow equivalent to the Wednesday interest added. Similarly, like this. So you will keep on adding the interest and borrowing it. That means you're doing the compounding. Now, Namita is asking, then why we have taken Saturday and Sunday 2 days of interest, why we have taken Saturday amount only to Monday? Why? Because the logic is that this money is being used for 2 days, Saturday night and Sunday night. That is the overnight, the money is being used. If the money is being used for 2 days, the bank will charge or the person will charge the interest for 2 days. Because Sunday also you are using it. If you don't want to use on Sunday, you should repay on Saturday itself. Correct? You should repay on Saturday itself to avoid 2 days of interest. But since you are using on Sunday also, you will have to pay the interest. Okay. So hence we have taken 2 days interest. Namita is saying, sir, ideally it should be called overnight interest rate swap. Why word index is used? Very good. Why word index is used? Because we said that index is what? Index is averages, right? Index is representing some collection. See, if we say that overnight, okay, I'll tell you. If you see the question, if you talk about only one bank, it is okay to use the word overnight interest, correct? Because there is only one interest for one bank. But if we talk about market, interbank market, then interest would not be the right word, index would be the right word, because index represents the collection, the averages. Index represents the movements of averages. Okay. Hence, we call it as overnight index swap. Okay. Because we are talking from the market point of view. Now, coming to the 10th question. A Inc. and B Inc. Okay. A Incorporated and B Incorporated intend to borrow $2 lakh and $2 lakh in yen respectively. So the other company wants to borrow in some other currency, not in dollars, but they want to borrow $2 lakh equivalent amount in yen. Okay, that is B Inc. I'm saying. For a time horizon of 1 year, the prevalent interest rate are as follows: A and B for yen, and this one is given. The prevalent exchange rate is 120, and that is kept constant. There is no change that is happening. Now, Harshad, I don't know whether it would be 12 a.m., 10 p.m., 6 p.m., because different banks would have, or different markets would have different cutoff dates. Okay. So it is not right for me to comment. It will always be 12 a.m. Okay. So there is a cutoff of the market, right? The banking transactions also have a cutoff. Let's say 5 p.m., 4 p.m., 6 p.m. It depends. So at that point of time, whatever is the balance, on that the interest will be charged. Okay, Harshad? So hence, it is not right for us to comment whether it will be 12 a.m. or something else. Okay. Then A Incorporated, B Incorporated, we studied, and exchange rate is same. Now they entered into a currency swap. Okay. Now this is a currency swap. Now they are detailing out what is the currency swap. Okay. Now read it very carefully. Okay, Naveen, thank you. They entered into a currency swap under which it is agreed that B Incorporated. Let us tabulate all this information. B Incorporated will pay A Incorporated 1% over the yen loan interest rate which the latter have to pay. Later means A. Correct? Later in the statement, later is used for the person who is coming later. I mean afterwards. So it is for A. So that A has to pay as a result of the agreed currency swap. Now A has to borrow in yen. So 1 plus 5% is what A Inc. is going to do. Whereas A Inc. will reimburse interest to B Inc. only to the extent of 9%. Here, he will reimburse only to the extent of 9%. Okay. Keeping the exchange rate invariant, they have said that exchange rate will be like that only. Quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. Now, how come it is a swap, students? Now, you can now think it from the angle of swap bank, although the question is not asking you to think, but I want you to think. Now think from the point of view of swap bank, you have got two companies, A Inc. and B Inc. Correct? A Inc. have come you with a proposal that, okay, if I borrow in yen, I get a rate of 5%. If I borrow in USD, I get a rate of 9%. B Inc. says that if I borrow in yen, I get a rate of 8%. If I borrow in USD, I get a rate of 10%. How should we borrow? A Inc. says that my preference is to borrow in USD. B Inc. says that my preference is to borrow in yen. Swap bank will run its own thought process and say, okay, I will form two options. Option number one, please note, this is not part of the solution. Okay, I'm just making the understanding clear. Option number one, I will ask A Inc. to borrow in yen and B Inc. to borrow in USD. What would be the rate applicable? A Inc. in yen is 5% and B for dollar is 10%. How much the total cost of the overall will be? 15%. What is option 2 available? A in dollars plus B in yen. So A in dollars is 9% plus 8%. comes out to 17%. What option would you suggest? Option 1. But the preference is vice versa. The preference of A is to borrow in USD. The B preference is to borrow in yen. But we are asking them to borrow respectively. So swap bank, which is us, we have to arrange for a swap, which is what they have also told us. This is nothing but already they have told that the swap will happen like this. We will ask them to borrow in yen and dollars A and B respectively, and then they will swap. And the swap will happen in this manner. Simple. Okay. So first of all, now this is the solution. A Inc. should borrow in yen, as a result of which the interest is paid out as 5%. B Incorporated should borrow in dollars, which is 10%. Overall cost will be 15%. Correct? This is the overall borrowing cost for 4 lakh USD equivalent amount. Correct? Because 2 lakh A will borrow, 2 lakh B will borrow in their respective currencies and all, and this will be the thing. Now, let us understand the opportunity gain / loss from A's point of view, and this we are doing in calculation in dollars. Okay. Why? Because A is having a preference of dollars. That means A would be operating in dollars. Correct? First of all, interest to be remitted to B. As a part of deal, as a part of swap, A has to pay interest to B. Correct? Which is how much? On 2 lakh USDs, we have seen what is the swap deal. Swap deal is A will pay to the B 9%. We are going step by step, okay? 9% for 1 year. Simple. It is $18,000. So first of all, A will pay to the B 18,000 USD under the part of deal. And now A will receive the interest from B under the part of this deal as 6%. Correct? 5 plus 1, that is given in the deal. So interest to be received from B, 2 lakh into 6% into 1 year. So 12,000 is the interest that will go on and reduce our cost. Correct? Because we are calculating the overall interest that needs to be paid. Okay. Then the regular interest that A will pay is 5%. Correct? Because A will borrow in yen, right? So it will pay 5%. This one. So interest to be paid on loan. What I should write here is, instead of 2 lakh USDs, the better thing to write here will be, so 120 is the rate, right? So it has borrowed in yen. So the better representation will be that 2 lakh into 120 is the total amount of borrowing, which is 24 million, 2 crore 40 lakhs. This is in yen, right? On this, he will end up paying 5%. And since we are doing the calculations in USD, we will again convert it back to USD divided by 120, keeping the rate same. Okay. 5% divided by 120. 10,000 USD he will pay. So net he will end up paying 16,000 as the interest cost under swap. Interest cost under currency swap is 16,000 USDs. Now, what if he has not entered into the swap? He would have borrowed in USD, correct? At the rate of 9%. So we can mention here interest cost without swap would be 2 lakh USDs into 9%, which is 18,000 USDs, correct? So this will mean that there is a 2,000 USD opportunity gain. Or I can say these are the net savings because of the swap. Because if he has not entered into the swap, he would have ended up borrowing at 9% in USD and paying this 18,000 rupees, 18,000 USD. Although under the swap, he only needs to pay 16,000. That means net 2,000 USD is what he's excess getting as a gain under the swap. Now this is all a very cakewalk for all of you because you have understood the positions from company A, company B, and swap bank point of view. The same thing applies to this currency swap, correct? So this thing is very easy for all of you, I'm assuming. Now coming to the opportunity gain or loss from the point of view of B. For B, we will calculate in yen because their preferred currency is in yen. So let us calculate in yen. We will just see, don't get scared by changing the currency because the rate is 120. You have to just apply a factor of 120, which is invariably the same. It is just adding one more step to the calculation, but it is not making the calculation complex, correct? Now, first of all, B to remit interest to A is how much? 240 is the loan amount, correct? On that, B will pay to A as 6%. It is mentioned here, correct? So B will pay to the A as 6% for 1 year. This comes as 14,40,000 yen. Okay. Then B will receive from A, B to receive from A interest, correct? On the same principle of 240, it will receive 9% for 1 year. That means it will end up receiving 2160. Okay. Then B to pay interest on loan. The regular interest to be paid on loan is 240 into 10%, correct? Because B has borrowed in USD, correct? This one, USD. So it will end up paying 10%. So what I'm suggesting is we can even do the same presentation here because it has borrowed in USDs, correct? So $2 lakh multiplied by 10% and this whole multiplied by 120 to convert it into yen, correct? Which is 24 lakh rupees. This all comes as 16,18,000. This is the net interest cost under swap. Okay. What is the interest cost without swap? See, if B Incorporated have not entered into the swap, they would have ended up taking a loan in yen at the rate of 8%. So this will come to how much? 8% on 24. 2 crore 40 lakhs will be 19 lakhs 20,000. This is the yen that they would have paid, but they are paying a yen of 1680 only. That means there is a gain of, so there is an opportunity gain on account of swap. Is 240. I hope students this part is clear to all of you. Please do ask any queries till now. This topic is a very interesting topic, the entire interest rate risk management. It is a very technical topic and it is something new that we have not studied earlier. So this becomes very, very important and very interesting actually. So swaps are done, correct? That was the question on swaps. Currency swap, plain vanilla swap, generic swap. These three terms we have studied, and those swaps are basically for fixed for floating or floating for fixed, or from one currency borrowing to another currency borrowing to same currency. Now this situation, so students, what I want you to just understand the situation and then act accordingly, correct? Okay. So now let me move to the last question of the assignment. Then we will cover some of the theoretical part. Okay. With this, the practical part we will almost cover. Then we will cover some of the theoretical part. Okay. So now let's come to the question number 11. Question number 11 says, just a second. Yeah. Question number 11 says, a textile manufacturer has taken floating interest rate loan of 40 lakh rupees on 1st of April 2012. 1st April 2012, he has taken a loan of 40 lakh rupees, which is actually a floating interest rate. Okay. The rate of interest at the inception of loan is 8.5% per annum. So when we started, the rate of interest is 8.5% per annum. Interest is to be paid every year on 31st March. So that means there is a yearly amount that has to be paid. The reset dates are 31st March, 31st March, 31st March going forward. Okay. And the duration of loan is 4 years. That means for 4 years, the interest will be taken on a reset basis. In the month of October 2012, that means somewhere in between. This is October 12. This will be March 13. This is the reset date, correct? This is the reset date, but they are saying somewhere in between the year only. somewhere between the year only, we come to know that the Central Bank of country releases the following projections about the interest rates likely to prevail in future. Okay. They are coming up with a projection that interest rates are going to change in future. Now, what are those things? On 31st March 2013, at 8.75%. Okay. Then next year it would be 10%. Then next to next year it will be 10.5. Okay, let me note it down. 31st March 13, 8.75%. Then 14, 31st March 14, it is coming as 10%. Then 31st March 15, it is coming as 10.5%. 31st March 16, it is going to come as 7.75%. Okay. Now, show how this borrowing cost can hedge the risk arising out of the expected rise in the rate of interest when he wants to peg his interest cost as 8.5%. Now, what they are trying to say is that you imagine a situation that there is a textile manufacturer, he has taken a loan. The loan is based on the floating rate of interest. The floating rate of interest are going to go up as per the recent projections released by the Central Bank of country. Now, with this situation, he wants to peg, he wants to cap, he wants to take a cap option. Then only he will be able to peg the interest cost at 8.5% per annum. And he is asking us what are the possible options? How can we do that? Since the wording is that he wants to peg the interest cost as 8.5%, that means the maximum we can go up to 8.5%. Correct? Hence, we want him to take a interest rate guarantee option. We want him to take a interest rate cap option. We want him to take, correct? With a strike rate of 8.5%, or we can say cap rate of 8.5%, but there will be some kind of a premium that will be applicable because he is getting some kind of a guarantee here, correct? Simple. Now, second part is saying, assume that the premium negotiated by both the parties is 0.7%, 0.75% to be paid on October itself, because the deal is happening in October, correct? So 0.75% to be paid in October, and the actual rate of interest on the respective due dates happens to be. Now, he's saying that the question is saying that the premium is 0.75% and the actual rate of interest on the respective dates is given as March 13, 14, 15, and 16. All the 4 years, the actual rate is given. Show how the settlement will be executed on the prospective interest due dates. Now it is asking us to calculate the settlement. Now the settlement means we only have to calculate under this interest rate guarantee what is the net payoff, correct? So first of all, there is a expiry (4 years) up to 31st of March, correct? This is what it is given in the question 16. So October. So let us see the periods, different periods. October 2012, correct? This is the date in which he comes to know about the information and he goes and takes an interest rate guarantee at 8.5%, correct? So on this date, he will end up paying 0.75% on the entire loan amount as the notional amount as premium. So this will be around 30,000. Okay. This will be around 30,000. Now, 31st March 2013. This is the first reset date. Okay. Now on the reset date, what is the interest rate? 10.2. Correct? On 31st March, the actual rate is 10.2. The cap rate is 8.5. So on 40 lakh rupees. Now tell me, students, since this textile manufacturer has purchased the interest rate cap option, will he be getting any amount? Yes, because the cap rate is 8.5. The open market rate is 10.5, 10.2. That means he will get an amount from 10.2 minus 8.5 equivalent value to his account. Okay, so 40 lakhs into 10.2 minus 8.5, because the option writer will make good any loss beyond 8.5 percentage. So the differential will be paid, correct? So this comes around 68,000. So 68,000 will be the received. So this will be received by textile manufacturer from option writer. Okay. March 2014. Now, what is the rate, actual rate on 31st March 2014? 11.5. Now, since it is 11.5, still it is higher than 8.5, right? He will get more than 8.5, whatever it is, he will get. Yes, Namita, right. He will get 68,000. That's correct. In this case, how much he will get? 1,20,000. So this will be received by textile manufacturer. See, students, he has paid how much? Only 30,000 as premium. And till now, he has got a benefit of 68,000 and 1,20,000, correct? So this deal is proving to be good for him. Now, let's come to the next reset date. The next reset date is 31st of March 2015. The rate is 9.25. If the rate is 9.25, it is still higher than 8.5. Still, he will get some amount because that is the characteristic of interest rate option, correct? Into 9.25 percentage minus 8.50 percentage, that brings out to 30,000. 2.75 divided by 4. Yes. So 30,000 will be the amount. Received by textile manufacturer again. This is the last date. Now in the last date, what is the rate that is there? 8.25. Now students, you see, open market, the rate is 8.25. Cap is at 8.5. Do you think the option will be exercised? No. The option will not be exercised because in open market itself, he can go and get the lower interest rate. So there is no need to exercise the option because he is holding the option. Okay, so this no payout, no settlement basically on 31st of March 2016. Now, let me take the queries. Namita is asking, sir, by reading question, how we came to know that A incorporated. Namita, please complete the question because I have got till this number only, till this characters only. Just repeat the question. Okay. Then again, question is, sir, as plain vanilla option is without any complexity, so what can be the complexities in an option? See, Namita, as we just now studied the currency swaps, correct? Now, currency swaps is again a very complicated situation. In case there is a different exchange rate on settlement, in case there is a different exchange rate on the initiation of the contract, different exchange rate on the interest payment, different exchange rate on the settlements. In that case, the question will give us direction that what exchange rate we have to follow. That will complicate, correct? Plus, the another type of complexity is that instead of fixed for floating or floating for fixed, they can enter into this kind of a currency swap that we have just now discussed, correct? In that also the complexities can add on. But don't, I mean, the general concept remains same. Swap is that we are getting something for something in return. We are paying something and we are getting something in return. Simple. And that what is that something in something will be defined in the question. No, Namita, I think this, acha, you have mentioned 2014 is 1 lakh 20, 2015 is 30, and 2 lakh 2016 is nil. Perfect. Yes, Namita, that's right. Okay. Now let me go back to the introduction session that we did yesterday on interest rate risk management, and from there upon, I will cover some of the balance part that is left. Okay. Yes, students, please pay attention. I want all of you to please pay attention. Don't think theory is not important. Theory is equally important than practical, because this will strengthen your understanding and will help you to do the practical questions. Okay. So, interest rate risk management. We studied first of all what is an interest, or why is there a need to pay interest. First of all, why interest? Because of two things. One is there is a risk of non-payment. There is a risk of non-payment. Why that risk arises? Risk arises because you are exposing yourself to the period of loan. If you are giving a loan, you are exposing yourself to the period of loan. We just now studied, now your understanding is now mature enough. What is overnight and what is LIBOR, normal LIBOR or normal MIBOR? The normal LIBOR or normal MIBOR will have a risk of non-payment, but overnight rate will not have a risk of non-payment, because we are lending for overnight, and it is generally not expected that a company will go bankrupt overnight. You're getting my point? There will not be any much change between what the company is today and what the company is going to be exactly tomorrow. Hence, the risk depends on two things. One is the credit rating and one is the period of loan. Correct? As we have just now studied, if the we have seen one question on credit rating also, in which ABC and XYZ were approaching a DEF limited bank. XYZ have a ABC have a poor credit rating, hence bank have quoted a higher interest rate. So those all things are very much there. And practically also, if you think, the second reason of interest was inflation slash time value of money, because as and when the time progresses, the money loses its value. 1 rupee will not have the same value today when we compare it to the 1 year after from now. Because if one standard basket of goods we are getting at 100 rupees, the same basket of goods we will get at 120 rupees after 1 year. Okay. Now, interest is dynamic. We studied that interest is dynamic. Interest is not a constant thing because it depends on a lot of things. It depends on the economy interest rate cycles. First of all, the economy, if there is an interest rate cycle going, if the economy is going up, there is inflation, interest rate, the central bank will increase the interest rate so that the credit becomes costlier and the purchasing power of the people goes down, and hence the inflation is properly handled out. Okay, the inflation is reduced. But if the economy is going through a depression and there is a falling inflation, in that case, interest will go down so that the credit the credit becomes cheaper in the market, and the people take more on credit and do the investment or do the spending so that the economy revives. Okay, this is what we studied, the economy life cycle, the interest life cycle. Now, taking from thereupon, we said that at micro level, so these are the impacts at macro level, correct, at economy. But at micro level, the interest rate changes the balance sheet and the P&L of the company. Okay, there are some assets and there are some liabilities in the balance sheet of a company which are linked to the floating rate, like floating loan that we have just now seen. In case the rate changes, the valuation will also change and the P&L will also have an impact on net interest income and assets and liabilities. We studied these things, correct? Now let me elaborate from here. Let us study what are the different types of interest rates risk. Students, you can note it down later also, because I have this option to add the pages you might not have in your notebook. So you can note it down in the later part of the notes also. Okay. Anyways, I'm just presenting you what is there in the study material in terms of the types of interest rates risk. The exact theory you can refer from there. See the types of, sorry. Yes, so the types of interest rates risk, or we can see that what are those different types of exposures, because risk is an exposure, correct? So first and the most complicated or the most understandable exposure is gap exposure. Now, what is this gap exposure means? So imagine a balance sheet. I'm just making it in T form only, okay? Don't go by the exact format or schedule. I just want this thing to be clear. Here I'm putting equities and liabilities, and here I'm putting assets. Now, students, I want responses from all of you. Now, all of you tell me, for a bank's balance sheet, what would be coming under assets? Generally, whatever you can imagine, just keep on posting it on the solution handle, or sorry, the query handle. We will just put all those things. First of all, I'm asking under assets, in the bank of under a bank's balance sheet under assets, what all components will come? Please participate as much as possible. Please put whatever do you think, whatever do you imagine, or if your practical experience, you have done any bank audit, you would have seen. Just say whatever things comes. I'm waiting for some of you to respond. Yes, Harshad. Loan given. So can I say, let's say, mortgage loans? For example, they have given a mortgage loan. In securitization, we studied mortgage loans. Mortgage loans are basically the loans that are paid for the housing. So these are housing loans basically, and they take mortgages for the same thing, correct? These are generally ranging from 15 to 25 years. Generally, I'm saying for a longer time period, correct? Then what all other things would be there? Friends, please. Investments purchase. Good, Namita. Investments. Naveen is saying we can tear and insert a page. No, 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 we're not required to do. You can note it down later also. Okay. Don't do that, Naveen. Don't waste your efforts in doing that. Rather, let's focus here. Okay. So Namita is saying physical assets. Okay. Then Harshad is saying cash with RBI. Very good, Harshad. Okay. Very good. So I think we can start our discussion with this. If any more suggestions comes from you, I will keep on adding this. Correct. See, there is a cash with RBI. Oh, credit cards. Naveen is saying credit card. Very good, Naveen. Sorry, I'm just writing Naveen instead of credit cards. Yes. Whatever amount that they have given in the form of a credit card, because credit card, what happens is the user of the credit card will swipe it, the bank will pay it first, and then user will pay it to the bank later. So whatever bank have paid now, for which there is a receivable from the user, that will come under the credit cards, right? I'm just, see, I'm not putting a very good presentation here. Again, I'm saying this is not the correct balance sheet presentation, because you might have to club current, non-current assets, right? All those things, financial assets, non-financial assets. I'm just putting the layman words here, correct, for us to understand. Good. So we have good amount of things to start with. Now, okay, Nostro account. Okay, Arshad. Let me just put one more thing which I want to put. Then we can keep on debating all these things. Uh, Mortgage loans. Yeah, I want to put one more thing, car loan. Okay. Now come to the equities and liabilities side. What all things we will see under equities and liabilities? You guys keep on posting. I am also keep on writing. Then we'll see is there something else. Equity is issued, correct? Whatever is the equity issued by the bank, first of all, that will come. Then if there are any borrowings that are happening, correct? I will translate these borrowings into two parts. Then I'm missing the most major thing that the banks play upon. Can anyone tell me under liabilities what is the majority thing that the bank have? That's it. Okay. Namita is saying SLR amount. SLR, and then Namita is saying CRR amount. Okay, so I am just saying that this will be basically cash with RBI or some surplus cash, or basically, okay, let me mention SLR, CRR. Okay. Whatever it is, it can be with cash with RBI. CRR will be within the cash in hand. SLR will be cash with RBI or with other banks, whatever it is. But I'm mentioning whatever you guys are saying. Okay. IRO account. I don't know IRO account, Harshad. Okay. Frankly, I don't know IRO account. If you can detail it to me, it would be learning for me also. Okay. So borrowings and tell, okay, now coming to this main business, I'm asking what is the biggest thing I've missed here. Okay, tier one and tier two bonds, liabilities deposit. Very good, Naveen. Very good, Naveen. Very good, Namita. Very good, Harshad. FD, yes. That is the main, income earning funds for the banks, where they take savings from us, people like us, or FDs from us and deposits from us, and they lend it to the big corporates. Correct. That is where the banks play and earn most of the interest income, because they pay us less and they earn more. Very good. I'm getting very good answers. Deposits, FDs, savings. Savings also I'm saying as deposits. Don't confuse it. Or let me put like this. Deposits as FDs and RDs, recurring deposits, and then savings account. Whatever are the collections on account of savings account, that will also come. Very good. Now let us start our discussion from here. Loro account. Okay, Harshad. You have gone to the FEMA foreign exchange. Let's restrict ourselves to the this balance sheet now. Okay. Mortgage loans are generally floating, correct? Because bank will not restrict itself for committing of funds for 15 to 25 years for a fixed rate of interest, because it will say that the period is more, it's better to link it under a floating rate of exchange. On the other hand, car loan can be fixed because the tenure is generally 2 to 3 years, correct? It's a shorter period. Bank says as okay, who will go into the hassle of every time revising the rate? We will go with a fixed rate of exchange. We will go with a fixed rate of interest for a car loan. Okay. Investments. Investments can also be floating or fixed. It can be anything. Correct. If I give you an example of floating rate of interest, let's say the bank have invested in a bond of a company that pays a floating coupon rate. That is a investment in the floating. That is a investment in a floating interest rate. If the banks are investing in the bonds which pays only fixed coupon rate, that will be the investment in the fixed. Correct. Physical assets will be more or less fixed. Cash with RBI fixed. Credit card will also be fixed. Correct. Or credit cards, there can be changes as per the time. Correct. So it can be fixed or floating, that we can debate separately. SLR, CRR will be fixed. Correct. Equities will be fixed. Borrowings can also be floating or fixed. If I take a loan on LIBOR plus 10% or LIBOR plus 10 basis points, it will be a floating rate. If I take a loan directly at 8%, it will be a fixed. Correct. If I take a loan on MIBOR, it is a floating. Correct. So similarly, deposits are this is generally fixed during the tenure. This is also generally fixed during the tenure. During the tenure, it does not changes. The deposit and savings accounts is all fixed only. They will not change anything on the savings account. Correct. So what I'm trying to say is that if you analyze a bank's balance sheet, you will get some assets and some liabilities that are floating. Certain assets and certain liabilities. And there will be certain assets and certain liabilities that will be fixed. There will be certain assets, certain liabilities on floating basis, certain assets, certain liabilities on fixed basis. Correct? This we have understood. Now, if the assets are on floating basis, any change in interest will have an impact on the valuation and net interest income. That you agree with me, right? If there is a change in interest, there will be a change in the valuation of the assets and liabilities that will go to the balance sheet, and there will be a change to the net interest income that will go to the P&L. Simple. Similarly, for fixed, change in interest might not have an impact at all. Correct? So Namita is saying, sir, why can't we say LIBOR plus 2%? Why we have to say in basis point terms only? Because it is more professional, Namita. Correct? If you say plus 2%, then we will act like that we are very layman. But if we have to act like we are professionals, basis point is a technical term. Correct? So I would suggest, because if you go through the monetary policy of RBI, okay, do you know that every 2 months, every bi-monthly or every monthly, I don't know, the RBI releases a monetary policy. It is a very good policy you should all go through with. In that, they will always say that RBI has decreased the repo rate or reverse repo rate by this much of basis points. Correct? So if you see, it is a general term that is used in the industry. correct? And I mean, basis points is just simply the norm that we should use. Okay. Now, what I am saying further is that on liabilities, you will end up paying interest. On assets, you will end up earning interest income. Correct? This is what you will do. That's the normal thing. And what we know is net interest income is equal to interest income minus interest expense. Okay, this we all know. I'm trying to prove something through this. We will just go to some of our conclusion. This is just a base building for that. Okay, now what does the gap exposure means? Because we were studying gap exposure. Now we have to relate this thing to the gap exposure. What does the gap exposure mean? So gap exposure analysis says that you perform certain steps. First step, determine interest rate sensitive IRS, interest rate sensitive assets and liabilities. I hope all of you would have understood. This is what we just now did. We just now checked that what is the floating out of this entire balance sheet, what assets are floating based on the floating interest rate and what liabilities are based on the floating interest rate. Those assets and liabilities are called as interest rate sensitive assets and liabilities, which are dependent on the floating interest rate. Okay, I hope this is very clear to all of you. This is IRS, does not mean Indian Revenue Services. This is interest rate sensitivity, interest rate sensitivity of the from the assets and liabilities standpoint. Okay. Step 2. Step 2 says that, okay, first of all, you have calculated the IRS A and IRS L. IRS A is the asset, interest rate sensitive assets, interest rate sensitive liabilities. Now, for example, in this, you have a total of 10 crore. Both the sides, you have a total of 10 crores. Out of this, around 6 crore is interest rate sensitive and around 3 crore is interest rate sensitive liability. For example, I'm saying, okay. So in step 2, we have to calculate the gap. Calculate gap. What is gap now? Gap is equal to IRS A minus IRS L. Okay. What is the interest rate sensitive asset minus interest rate sensitive liabilities? Which is, in our example, will be 6 minus 3 is equal to 3 crore. This is the gap. This is the gap exposure. Now, here comes the conclusion, which is the last thing. Now, if gap, now there can be only two things. Either it can be positive or it can be negative. Or the third thing, it can be zero also. If it is zero, that means there is no gap exposure. Now, we will study if it is positive, if it is negative. When it will be positive? When asset is higher than liabilities. This we are talking about only interest rate sensitive assets and liabilities, correct? And negative will be when asset is lesser than liabilities. This is again interest rate sensitive assets and liabilities. So if it is positive, then in this case specifically, if interest increases, If the interest rate increases, you will have a higher interest income than the higher interest expense. You're getting my point? Your interest income will be higher than the interest expense because you have a higher interest rate sensitive assets compared to the interest rate sensitive liabilities. For example, there is a interest rate increase by 10%. For example, so you will end up paying, let's say, 60 lakhs higher interest. Sorry, you will end up receiving 60 lakhs higher on assets, but you will end up only paying 30 lakhs interest on liabilities because your liabilities value is lesser than the assets value. So that means your net interest income will be higher by 30 lakhs. Okay. So if the interest is higher, then NII will also be higher. This is net interest income. Okay, students. On the other hand, if interest is lower, then NII will also be lower. Simple. Because you will lose more interest on the assets compared to the liabilities. Why? Because your assets are higher. If the interest goes down, if the interest rate goes down, you will end up receiving lesser interest on the assets and you will end up paying lesser interest on the liabilities. But the extent will be that overall you will be lesser because your asset base is higher than the liability base. I hope you're able to understand this. Now I want answers from all of you. In case the gap is negative, what will happen if interest increases? Then NII, where it will go? It will increase or decrease? Now, students, I want answers from all of you. Just think logically and then tell me. If the assets are lesser than liabilities, I'm talking about only the interest rate sensitive assets. Huh? If the interest rate sensitive assets are lesser than the interest rate sensitive liabilities and the interest is going to go up, then what impact it will have on the net interest income that is reported in the P&L? Students, please answer so that please attempt. Don't be feared of putting a wrong answer. Just attempt what you want. I mean, what is your thought process? I hope it would be right only for all of you. If the gap is negative, what would be the interest increase will have an impact on the NII, net interest income. Yes, Arshad, perfect. It is interest payable. Interest payable will be higher. Lesser NII, Naveen, very good. Very good, Naveen. So we will have a lesser II. Very good. Both of them have answered correctly. And maybe all of you would have thought the same answer. If the interest rate goes down, then NII will increase. Simple. Okay, this is what the net thing is, and this is what the gap exposure is. Gap exposure is nothing but it can be positive or negative. Difference between the interest rate sensitive assets and liabilities. If the gap exposure is positive, then interest rate increase will have a positive impact on NII. If gap exposure is negative, any increase in the interest will have a negative impact on a NII. Simple. Next comes the basis risk. Now, as I told, that basis is what? Let's say 0.10% will be 10 basis points, correct? Similarly, 1% is 100 basis points. So basis means the magnitude, correct? The magnitude of the let's say here is it's of a magnitude of 10, which is equivalent to the 0.10%. Simple. Correct. Now, what does basis means? Now, students, we have seen that there are interest rate sensitive assets. There are interest rate sensitive liabilities. Now, all these interest rate sensitive assets in the gap exposure, we have assumed that, let's say, if the interest changes by 10%, it will have a 10% impact on all the assets. It will have a common impact of 10% on all the assets, and it will have the common impact of 10% on all the liabilities, which is not true actually. Which is not true, because a 10% change in interest might have a 8% impact on some assets, 7% impact on another assets, 12% impact on some other assets. Correct. Similarly, on liabilities also, some liabilities will get impacted by 5, some by 15, some by 10. There can be different magnitudes of impact. There can be different basis risk sitting in the individual IRS A and IRS L. This risk is called as basis risk. Although the interest is changing by 10, but the asset will change only by 8. This 2% is defined as basis risk. Okay. So interest rate of different items will change in different magnitude. I hope all of you are getting my point. The interest rate of different items will change in different magnitude. The magnitude is not fixed, correct? So that is called as basis risk. Something can change by 80 basis points. Something can change by 10 basis points. Some assets can change by 50 basis points. Some liabilities can change by 100 basis points. Even if the interest rate changes only, let's say, 50 basis points. So that is called as basis risk. Now, next point, embedded option risk. Now, students, what happens? Okay, let me tell you, there is a instrument called callable bonds. What are these callable bonds? Callable bonds are such bonds which come with a condition that it would be purchased back by the issuer before maturity. Now, students, please understand this point very carefully. What are callable bonds? See, first of all, there are certain bonds which are regular bonds, simple bonds, plain vanilla bonds, whatever you can say. There are certain bonds which are called as callable bonds. Callable bonds comes with a condition that today a company is issuing a bond, but let's say the maturity period is 5 years. So within that 5 years, they can take back the callable bonds. Take back means they will pay the amount back and they will get back their securities, the company. Okay, that is called as callable bond. Now, if you understand this callable bonds, there are two things, callable bonds. One is the straight bond itself, correct? That will keep on paying you the interest for 5 years. And there is a call option. Call option in derivatives we studied. Call option gives the holder the right to buy, correct? Here also, right to buy is with the issuer. Right to buy with the issuer. Issuer is who? Who has issued the bonds. Who has issued the bonds. That company is holding the right to buy its own bonds. Okay. Now, what is the embedded option risk. Embedded option risk is this option is first of all embedded in the callable bonds, correct? Call option is embedded in the callable bonds, and if this option is exercised before maturity, correct? If this option is exercised before maturity, then the holder of the bond will lose interest and the issuer of the bond will save on interest. You're getting my point? So there will be an impact on interests payments. This is clear? Because if the bonds are taken back by the issuer before maturity, it will impact the NII of both the issuer as well as the holder. That is why this is called as embedded option risk. Simple. Okay. Now comes the fourth type of risk, that is called as yield curve risk. Yield curve is nothing but the interest rate, correct? If you plot the interest rate on x-axis and y-axis along with the maturity, that is called as yield curve. For example, this is the x-axis and y-axis. Here you plot maturity: 1 year, 2 year, 3 year, 4 year, 5 year, 6 year. These are different types of maturity. Years in maturity. Sorry, maturity in years. We should write maturity in years. Okay. Let's say you have something for 1 year maturity, then this will fall here. What is the yield of that? Yield means interest. Interest percentage, we can say yield. Okay. It will be lesser. We have just now seen the interest for lesser maturity is lesser, correct? Higher maturities is higher. So the yield curve generally is like this. Normally, it is positively sloped. It is positively sloped. Why? Because higher maturity will have higher interest because of the higher risk. The maturity, if let's say is 5 years, then the instrument is getting exposed to 5 years, which is higher. So this is a general principle. Lower maturity, low yield. Higher maturity, high yield. Correct. This is called as yield risk. So Harshad and Namita, both of you are asking the same question actually. The beta of security measures the interest rate sensitivity. Is there a concept to measure the interest rate? Sorry, beta is measures the price rate sensitivity for a share. Is there something to measure the interest rate sensitivity? Typically, see, if you see the beta also, beta is nothing but the sensitivity in relation to that of a market, correct? Definitely for interest rate sensitivity also, we can define that relationship between the interest rate changes and the asset changes. Because of that, we can calculate that. But technically, I'm not aware what is the right word that is called for that. But if you ask me conceptually, yes, we can calculate that sensitivity, correct? Now, if there is a higher maturity, there is a higher yield, lower maturity, lower yield. This is what called as, and if you assume bond to be 30 days maturity and bond with a 30-year maturity, obviously the yield of this bond will be higher and yield of this bond will be lower compared to both of them, correct? If this is the graph in an economy, that means the economy is under a growing model. Economy is in growing model, because the lesser maturity have lesser yield and higher maturity securities have higher yield. That means the investors have confidence in the market that if they are going to invest for a longer duration, they will be going to get a higher interest, correct? But there are certain economies where the graph is vice versa actually. This is, let's say, maturity, and this is the yield percentage. Okay, now here what is the expectation? The expectation is that we don't expect that in future there is a growth. See, if it is a negative slope, I'll tell you what is the thought process. Negative slope means, see, first of all, investor expects economic growth to be slow. Why? Because they are expecting the interest rates to fall. If 1 year, 2 year, 3 year, 4 year, 5 year, if 5-year maturity have a lesser interest rate compared to 1 year maturity, that means in that economy, there is an economic slowdown going to come. And student, I'll tell you a very practical thing that you will, that you can find in Google it also. Okay, I'll tell you, just give me 1 minute here. I'm just completing this. Investor expects economic growth to be slow because there is an expectation of interest rates to fall in future, correct? That is what it is happening. In 5 years, the interest rate will fall. So what will happen is lower demand of high security maturity will be there. Now, what will happen as a result? Lower demand of high maturity security will kick in, correct? Because if an investor will now go, investor will invest in 1 year, 2 year kind of a securities maturity. They will not invest in 5-year security. Why? Because 5 years they expect the interest rates to go down. They have uncertainty for 5 years because they expect that economic growth is going to be slow. Okay, this derives the yield of long-term maturity lower. Now, this lower demand makes the yield curve to be negative, like I have shown above. I hope this is understood. So the changes in yield curve will lead to the changes in interest rates, and hence it is called as yield curve risk. Correct? Now, the practical part, the very practical part, friends, if you go and Google it also, I am keep on telling you the difference between OIS, LIBOR or MIBOR. See, this is overnight. This is 6 months, 3 months with a longer maturity, I'm saying, correct? That's what we studied. So can I plot in this chart OIS here and normal 6 months, 7 months LIBOR here? Okay, that I can do. So because overnight will be somewhere here, correct? Right after 0. Just a second. Now there is a term called, see student, again I'm saying this is not from the curriculum, this is just my interest, and I'm just telling you out of the interest only. We always see what is the spread. Spread means LIBOR or MIBOR, whatever it is. I am using both the terms because LIBOR is no more there as per. So we do this LIBOR, MIBOR minus OIS. This is called as spread. If this spread is positive, that means there is a positive slope, correct? Because in this we are saying that longer maturity will have higher, the longer maturity will have higher yield, correct? That's what we are saying. And the lower maturity will have lower yield. If there is the spread is positive, that means economy is very healthy, and higher the spread, higher the health is. If the spread is negative, if the spread is negative, LIBOR minus OIS, then that means the economy is going towards recession. Students, I don't know whether you know it or not. In US, there was a very big recession in 2008, in which a lot of people lost their livelihoods. Before that recession came in, lot of economists have studied this spread, and it was going out to be negative, and they warned the US economy that your spread is going to be negative, hence your recession will be kicking in. And that's how it happened, because the investor expected that in future there is no growth at all, there will be negative slope. Correct? If spread here, the spread is negative, right? Because OI, overnight security, will give you higher rate as compared to the long-term securities. Okay, this is what the point I'm trying to make. That's what I'm trying to say, is that this is the implication of what we are studying. Okay, now let me cover the other part. So this covers the yield risk, yield curve risk. Okay. Yes, now comes the price risk. See, now what is price risk? I will just cover these three risks very shortly. These are, so see, we know that bonds prices are actually inversely relation to the interest changes, correct? If interest changes happens, the bond prices will change inversely. That is called as price risk. Because if the interest changes, it will lead to the changes in the price. That is called as price risk. Reinvestment risk. So students, what happens in reinvestment risk is, see, we have studied the reinvestment. See, what does the reinvestment means? If you invest for 3 months, after 3 months, you will get the maturity plus interest, correct? In your principal plus interest as maturity proceeds. But that, if you're not able to use, that is still as excess that you can again invest. That is called as reinvestment. But that you will invest basis the interest rate that is after 3 months, not basis the original interest rate. So reinvestment risk is that when you reinvest, what is the interest rate going to be? If it is going to be higher or lower, it will go out as a reinvestment. Correct? Reinvestment risk is because we don't know at the time of maturity at what rate we are going to reinvest. And the last risk is net interest position risk. Now, what do we mean with this? Banks have more earning assets than paying liabilities. So see, this is the NII risk only that we have just studied. If your assets are more than liabilities, then interest rate will have a same impact on NII. Correct? If asset is lesser than liabilities, that we studied in the gap exposure, if interest rate increases, then NII will also increase. Sorry, NII will decrease. If interest rate decreases, NII will increase because you have lesser assets than liabilities for the payment. Naveen, you can go through the asset swap once. There is nothing much to cover in that. Still, if you have some query, please do write it to the email IDs, or you can call the direct number that is given. Okay. Anyways, we are all available only to help you all with the queries that you have. Please do write it to us in case you have any other queries left. With this, the interest rate risk management comes over. I hope you enjoyed the session, and please do revise well. Please do go through the recordings again if you are not able to understand. Still, you have some queries, please email it across to the email ID that is being given. Okay, so students, till then, we will better to go through it once and revise it, and we can now close the session. Thanks for your patience listening. So yeah, thank you.